In this presentation, we're going to record a transaction in Excel related to one company fully purchasing another company. So one company is going to be fully purchasing the other, this time with the use of issuance of bonds. So in other words, one company purchasing another company, however, not doing so with cash, but with the use of the issuance of bonds or debentures. Get ready to account with Advanced Financial Accounting. Here we are in our practice problem within Excel. We've got our information on the left-hand side. We're going to be entering that information into a journal entry in the blue area on the right-hand side, and we're going to post that to our simplified trial balance where we have the beginning balance, the entries, and then the ending balance for our trial balance. Now we have a similar situation to a problem we have seen in the past, and that we're talking about a purchase situation. So P, we're going to have a parent company and a subsidiary company. So P is purchasing S, P company, P purchasing S here. P used debentures or bonds to acquire 100% of S's net assets. So now P is purchasing 100% of S's net assets. So we still have that transaction type of thing. It's not like P's just creating, it's not like P's just breaking off some other company and restructuring to another kind of company. There's transactions happening, there's a purchase process, and therefore we're still going to have to basically revalue the assets of S within this transaction, just like we would in a normal kind of market type of transaction. So we're going to have that. The only difference here being the amount of payment or the type of payment, instead of being the easiest format of payment for us to account for, cash, now being bonds. So let's take a look at that. So we have then S company down here, net assets. We're going to break out some of their net assets in a little bit more in depth now. So instead of just saying all of their assets and their liabilities, we've got cash, inventory, so on and so forth. Notice what we would have to do is take their historical costs, basically, their normal balance sheet costs, and then recalculate them line by line to the fair value. So now we have the fair value costs, and that's what we're going to be using when we record the transaction of this purchase. So purchase has been taken place. We issued the bonds or debentures, and so we have then the par value at the $643,000 and the fair value at the $626,000. So now this is another area where it's a little bit different than cash, because we can't just depend on cash being cash either. We have to kind of value the bonds. What are the fair value, in other words, of the bonds that are being issued as well? Okay, so note that the complication here that we're not really dealing with, that's a complication in practice, is of course to get the fair value of the bonds. You have to calculate what the fair value of the bonds would be, and then to calculate the line by line fair value of the net assets. Not an easy thing to do, but that's going to be a necessary process for this type of transaction, which is basically a purchasing type of transaction. So, and obviously, if you were going to do this type of transaction to purchase each individual asset in that way, then you would probably do a similar process in any case, not just for reporting purposes, but for the actual, purchase process. All right, so let's then record this. So again, I'm going to record this as it goes. I'm not going to try to put the debits on top and the credits on the bottom. I'm going to record this how it makes the most sense to me to record it, and then you can go back in and make some adjustments to it if to put the debits on top if you so choose. So we're talking about then the company that's purchasing. P company here is making the purchase. We're going to be recording this transaction on P company's books. So then I would say, okay, well, what is P getting? What is P getting? Now, I know that they spent the debenture. I could start with that because I started with cash last time, but that's a little bit more of a tricky thing than just cash. So let's start with what we're getting. So I'm going to say, all right, well, they're getting cash. Cash is going up. And so cash and other assets, not just cash. That's why it's not the same. So, but we have to pick up the fair value here, not the historical. So I'm going to pick up the fair value of the cash, and the other assets are grouped together here. And then we have the inventory. So inventory, I'll pick that up, and inventory is going up at the fair value. So that's the key. It's going to be a longer transaction, but pretty straightforward, because we're just going to take every asset line by line. We're just going to say, all right, there's the land, and just make sure that we pick up the fair value line item for land, the fair value line item for land, and then the building and the equipment. Once again, the fair value line item for building and equipment. We're not picking up the accumulated depreciation because we're not picking up the book value. We took the book value, which is this minus this. We revalued it to the fair value, and that's what we're picking up. Now they had on their historical books goodwill on the books. And we're saying at this point, there's no value to it. So we're not going to record goodwill on the books. We're going to say then that we have, now that doesn't mean that we will not record goodwill with regards to this transaction. What we're saying is they already had goodwill on their historical books from some other thing in the past, whatever that goodwill is related to, which we're not valuing. We're not going to record that on our books. However, we may result in recording goodwill for this transaction as a whole. So you kind of got to keep those two things separate. This is the goodwill recorded on the S corporation's books, not the goodwill that's resulting from this end process at the end of the transaction, which could result in goodwill from this transaction. All right, so then we're going to say the accounts payable. So we're going to go on down to the accounts payable. It happens to be the same for the historical and the fair market value. We want to put this on the books as a credit now. So I'm going to say negative, and that's not unusual for it to be the same because it's basically cash that we owe. So it may very well be the same from a historical to fair value cost. Then we've got the common stock, additional paid in capital, and so on. What we need to record now then is going to be the bonds that we're going to record. So we're issuing bonds. So now we're going to issue the bonds. And so that we're going to say, okay, we're going to issue the bonds for the par value, or we're gonna record the bonds at the par value, the 643, but the fair value is this. So that means the fair value is less, so there's got to be a discount. So it's just like our bond type of transactions that we've, if you want to refresh on recording bonds when you issue the bond here, we're going to say, all right, the bond is going to go on the books. It's kind of like a liability. It's something that we're going to say we owe. It's going to go on the books for a liability for the full amount being the $643,000. Then what we're going to say is there's a discount because it's really only worth the $626,000. So we have to put a discount to bring it back down to basically the fair value. So I'm going to say, all right underneath it, I'm going to have a contra account, which is a discount. And the discount then is going to be a debit of, and I'm going to take the smaller number. Let's do that again. I'm going to say it's a debit of, I'm going to take the larger number minus the smaller number. So it's a debit. Okay, so there's the 17. So in other words, it went on the books for a credit of 643. This minus the 17 is the 626, which is, of course, the fair value. Now, the difference between this whole thing, once again, is going to be the goodwill. Because notice what we have here. We got, this is what basically we got on a fair value basis, which is the 571,000, and this is basically what we gave on a fair market value basis, 571 and the 626. The difference between those two, or if I just highlight the entire thing, given the debits and credits, the plug formula will be the 550 or 55,000. So let's just think about that this way one more time. Let's say, okay, this is what we got, assets minus liabilities is the 570, whoops, hold on a second. Let's undo that. I'm going to say, all right, let's put that over here, the trusty calculator. We're going to say it's 571,000 minus, and then this is what we gave up, the 626. So we're going to say minus the 626,000, and that's going to be the 55,000, right? Which is also the plug of the whole thing. So 55,000. So that's going to be the debit. So I'm going to say, all right, we need a debit then, a negative sum plug formula to bring this thing back in balance. So that we have that. And what's that going to be? Well, that's the goodwill, because once again, we paid more than the value of what we'd received. So we revalued the assets and the liabilities, and then we gave something, not cash, but something of value, that value being greater than what we received on a fair market value basis. Why would we do that? Because this stuff up here, even on a fair market value basis, is somehow not representing the true value of what we're buying. There's got to be something else. What is it? Intangible. We're saying it's got to be some intangible. It's got to be goodwill. It's got to be we're projecting future value to outweigh the assets minus liabilities just valued at their fair value for something like brand name or something like that. Okay, so that's gonna be our transaction. Let's record it out here. Now, this is a very simple, beginning balance over here, but I think it's just nice to be able to see these in terms of recording them to a trial balance and see them in their categories, assets, liability, and equity, and so on. So let's just do that here. So we're going to say, all right, cash. Then we're going to say we started with 100,000. It's going to be going up by the 43,000. Inventory, it of course is going up by the 184,000. Land, it's going to be going up by the 90,000. The building and equipment, it's going to be going up by the 300,000. We're not recording the accumulated depreciation. We're putting it on the books as if it's a new thing to us, right? And then we'll depreciate it from that point. And then we've got the accounts payable. Let's go down here. That's going to be the 46,000. We've got the bonds payable now, a liability goes on the books there, and then we've got the contra bond, right? The discount, the contra account, which is the discount account going on the books, and then we're going to have the goodwill. So then we'll have the goodwill now being the added intangible asset that goes on the books, and again, that typically only happens when there's some type of purchase process because that drives out. That's what really, that market transaction is the only time when we can really see that goodwill if there's an arm's length market transaction. If there's not, all we can do is guess at that goodwill, and that's, you know, you don't really want to give someone the company, the authority, the power to just guess at a number like goodwill. You know, it's too hard to really to really lock down unless there's an actual transaction. So when there's an actual transaction that happens, we could say, well, there's an arm's length transaction. That difference then looks to be goodwill. So we got the goodwill on the books here.